This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 5, 2026, and this is the New York pre-market. Now, let's get into it. We are tracking a market that is running hot, fast, and entirely focused on technology. As of 9:19 ET on Wednesday, August 5, 2026, the S&P 500 ETF, SPY, is sitting at $771.33, up 1.8%, while the Nasdaq 100 ETF, QQQ, is pulling ahead with a stronger 3.4% gain to $723.85. The divergence is stark. Tech is leading, everything else is following. And right now, the volatility index VIX is languishing at 15.86, practically asleep at the wheel. But beneath that calm surface, individual names are swinging violently, some gapping up 20%, others crashing nearly 8% despite beating estimates. Let's look at the tape. Before we dive into the charts, let's check the calendar. Today brings a batch of smaller cap earnings including AUK, ABCL, and ABUs, but none of these are moving the needle for the broader market indices we're watching. Tomorrow, there are no major listed earnings in our top 50 movers to monitor. So, with no scheduled macro releases or major corporate reports disrupting the flow, the market is free to react purely to the current price action and sector rotation. There are no external shocks expected, the drama is internal. Here is the snapshot. We have a clear rotation happening. The Technology Select Sector SPDR Fund, the technology sector, is up 4.98% to $186.90, dominating the board. Meanwhile, defensive sectors are getting dumped. Utilities, the utilities sector, are down 0.56% at $44.11. And healthcare, the healthcare sector, are flat at $162.10. The Russell 2000 ETF, IWM, is up 1.85% to $301.71, but it's still lagging the heavyweights. And in the noise, Shopify, SHOP, is jumping 21.9% to $150.25, while AMD is down 7.5%. That is the landscape. Pulse, give me the temperature. It's dangerously warm, narrator. We are seeing classic complacent euphoria. The VIX is at 15.86, which is right at the lower bound of its 5-day range, yet SPY is rallying hard into resistance. You don't get a 1.8% move in SPY with a VIX this low without a lot of unhedged longs piling in. It's a risk-on momentum that is completely detached from the underlying friction. We've got CPI stuck at 3.46% and a flat yield curve, but the sentiment is screaming buy.
And technically, they're heading right into a wall. Look at SPY at $771.33. It is just $2.08 away from its 5-day high of $773.41. QQQ is at $723.85, chasing its 10-day high of $725.66. The structure is aggressively bullish, sure, but it's stretched. We are trying to break out of a consolidation box, but the proximity to these resistance levels means any rejection isn't going to be gentle. It's going to be a mean reversion spike.
Because it's unsupported. You're talking about $2.08 of cushion, grid, but you're ignoring the structural stress. The 10-year minus 2-year yield spread has flattened to plus 0.43 percentage points. The bond market is telling us growth is slowing or inflation is persisting, yet equities are pricing in a soft landing with zero hedging. That VIX at 15.86 isn't calm, it's empty. There's no put volume supporting these levels. When SPY hits $773.41 and fails, and given the macro headwinds, failure is probable. The unwind will be violent because nobody bought insurance.
So we have a narrow lead. Let's talk about that leadership. The technology sector is up nearly 5%, but it's not uniform. CIPHER, break down the fundamentals driving this move.
It's a bifurcation, SPECTER. We aren't seeing a broad-based rally. We're seeing a flight to commercial AI over hardware infrastructure. Look at Shopify. It's up 21.9% to $150.25 on 3 times normal volume. That's institutional accumulation based on a pivot to AI-driven commerce efficiency. Compare that to AMD, which dropped 7.5% despite beating earnings. The market is rejecting legacy silicon plays that don't show immediate margin expansion and rewarding the application layer. ANIT is also up 10.7%, validating that networking spend is accelerating even as chipmakers face scrutiny.
But CIPHER, look at the breadth. You're highlighting Shop and ANIT, but what about the crowd? The sentiment around Shop is incredibly elevated, bordering on fear of missing out. A 21.9% gap up attracts retail money that doesn't understand the valuation mechanics. Meanwhile, AMD is down 7.5% with neutral sentiment. The disconnect is huge. If Shop starts to fade, that liquidity vanishes instantly, and it takes the technology sector down with it. You can't sustain a plus 9.24% weekly gain on just 2 or 3 names.
I agree with Pulse on the fragility. Technically, if the technology sector pulls back, the support levels are thin. For Shop, if it fails to hold the $150 level, we're looking at a quick fill of that gap. And for AMD, the damage is done for the day. It's testing support, but the volume profile suggests sellers are in control. Until AMD stabilizes, the broad AI narrative is technically broken on the chart. The engine room of the Nasdaq is sputtering.
Exactly. And this brings me back to the risk flag. You're calling this commercial VS, hardware. I'm calling it a liquidity trap. You have Shop up 20% plus on speculation, and you have the entire market ignoring that real GDP is only 1.5% and CPI is 3.46%. The Fed funds rate is still at 3.63%. How is a 20% gap justified when borrowing costs haven't come down meaningfully? The VIX at 15.86 tells me everyone thinks the party is endless. That's when the party ends.
Let's dig deeper into that resistance point. Grid, walk us through the SPY and QMQ breakdown. What needs to happen for this to be valid?
Okay, so SPY is at $771.33. The immediate test is $773.41. That's the 5-day high. To call this a true breakout, we need to see volume expand significantly as it crosses that threshold. Right now, the volume isn't showing enough conviction to break through cleanly. If we touch $773.41 and get rejected, we likely drift back down to the AUG4 open, which is $760.63. That's a big gap to fill. For QQQ, it's similar. They are at $723.85, hunting $725.66. If QQQ breaks $725.66, it confirms the tech strength, but if it stalls, the correlation to the technology sector's weakness becomes apparent. Also, watch the IWM at $301.71. If it doesn't break its own resistance at $302.39, it confirms this is a large cap-only rally, which is historically fragile.
And that large cap-only nature is the problem. Look at the sector flows. The technology sector is up 4.98%, but consumer discretionary is barely moving at plus 0.7% to $118.29. The energy sector is down 0.46%. The money isn't flowing into the real economy. It's staying trapped in the tech bubble. That's why Sharp is running away. It's the only place left with alpha. But fundamentally, if the technology sector stalls at resistance, there's no secondary engine to catch the falling knife.
Which explains the sentiment skew. Put your CACR on QQQ. If calls are dominating while VIX is sub 16, you have a leverage explosion waiting to reverse. The sentiment isn't just greedy, it's unhedged. When you have that much one-way exposure without any volatility buffer, a minor headline shock, like a hawkish comment from a Fed official, triggers a mechanical sell-off. People aren't selling because they changed their minds. They are selling because they are forced to deleverage.
And don't forget the defensive sectors. The utilities sector, utilities, and the healthcare sector, healthcare, have been hammered all week. Once those stop falling, you might see a relief rally in defensive names, which would actually hurt the high beta tech leaders. If bonds start rallying due to yield curve fears, money rotates out of the technology sector and into the utilities sector. That's the sequence. High beta falls, low beta rises. The VIX at 15.86 gives you false confidence that this won't happen.
Let's pivot to the outlier, Shop. It's up 21.9%. CIPHER, is this sustainable?
On fundamentals, yes, if you believe in the AI commerce pivot. They reported strong metrics, and the market is rewarding execution. But CIPHER-wise, watch the volume. 3 times normal volume is a lot of chips changing hands. If the bid side dries up tomorrow morning, that 21.9% gain evaporates. Compare that to ANIT, which is up 10.7% on solid Q3 results. ANIT is the safer play because it's backed by actual revenue beats. Shop is backed by narrative. In a rising market, narrative works. In a stalled market, narrative gets punished.
Technically, Shop is a wild card. It's not respecting standard support/resistance levels because the move is so vertical. If it closes below $145, it's a warning sign. But mostly its movement is dragging the sector. If Shop turns south, it takes the tech optimism sentiment with it. Keep an eye on the interaction between Shop price action and the technology sector ETF. If the technology sector starts to underperform Shop, the sector rotation is ending.
And that's the risk for the broader market. Shop is the canary in the coal mine for risk appetite. If Shop fades, retail traders exit, sentiment cools, and the VIX ticks up. We're seeing a feedback loop right now. Low VIX encourages buying, which pushes prices up, which lowers volatility perception further. It's a tight spiral. Break the link by having Shop stall and the spiral reverses. What about AMD? Down 7.5%, beat earnings. Why is the market punishing them?
Guidance. The market hates uncertainty, and AMD's outlook didn't provide the explosive AI-driven margin expansion that NVDA or ANIT provided. Investors are rotating out of Me Too AI suppliers. It's a fundamental repricing. They beat on the past, but missed on the future expectation. That's why the price is dropping despite the good report. It's a sell, the news event amplified by a lack of forward-looking excitement.
Chart-wise, AMD is breaking structure. It's down 7.5% and it's not finding bids. If it breaks below $479, the technical damage is severe. We'll likely see a slide toward lower moving averages. It's a clear downtrend until proven otherwise. Don't try to catch that knife.
This is the crack in the dam. If AMD continues to bleed, it validates my earlier point about the AI trade fracturing. It's not broad-based. It's a few winners and many losers. If the index QQQ tries to rally on the back of Shop and ANIT, but AMD drags down the semiconductor weight, the index hit will be capped. The SPY resistance at $773.41 is likely a ceiling, not a floor, precisely because of this fragmentation.
Apex tie this together. We have the technology sector leading but fragmented. SPY near resistance. VIX low. What is the structural reality?
The reality is a narrow, high-volatility squeeze. Grid, you noted the SPY resistance at $773.41, and CIPHER highlighted the divergence between Sharp narrative and AMD's fundamentals. Those 2 points combine to create a fragile top. The market is relying on Sharp and ANIT to carry the technology sector, but if AMD continues to drop, the AI label loses credibility. Pulse warned about the unhedged sentiment, and SPECTER pointed out the lack of volatility buffer. When you stack a narrow leadership group against a suppressed VIX and a flattening yield curve, the risk/reward skews negative. The data shows momentum is strong, but the foundation is cracking. We are watching for a break of SPY's $773.41 level, but the probability of a rejection increases as the day progresses without new volume.
So, to summarize, we have a tech-heavy rally with the technology sector leading, but it's narrow. SPY is pressing against $773.41 resistance with little room to breathe. Shop is the momentum star, but AMD's weakness signals a split in AI confidence. The VIX is too low for comfort, suggesting limited hedging. Tomorrow, watch for follow-through in Shop and ANIT, and monitor whether SPY can hold above $773.41, or if profit-taking drives it back towards $760. This has been ShadowQuant Equities Edition. Stay disciplined. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.